Welcome back to the final explainer of our ASE 230 series, drawing directly from the PNJ Group Financial Statements Training Handbook. In our last session, we really got into the weeds. We conquered the supplemental schedule, the foreign currency reconciling line, and those 3 mandatory supplemental disclosures. But today is the grand finale. We are officially shifting our focus from simply building the statement of cash flows to completely, unequivocally audit-proofing it.
So here's our roadmap for this explainer. 1. Avoiding cash flow traps. 2. Restricted and non-cash errors. 3. Thinking like an auditor. And 4. Building out your period-end playbook. Let's jump right in.
Starting off with Section 1, avoiding cash flow traps and those pesky common classification errors.
All right, picture this scenario. You're in the middle of a chaotic month-end close. A team member is moving fast and decides to classify a dividend paid to shareholders as an operating activity. I mean, it kind of feels like a normal, everyday cash outflow for a business, right? Well, you have to ask yourself, is that just a harmless assumption, or did they just step right into a major trap?
Yeah, it's a massive trap. Going with your gut and assuming it's an operating outflow is literally dead wrong. Under strict U.S. GAAP rules, dividends paid are absolutely always classified as financing activities, no exceptions. There is zero room for election here. Just by making that one rushed assumption, boom, your operating outflows were just incorrectly understated and your entire statement is basically flawed.
And honestly, it's kind of scary how easily these rapid-fire errors can systematically distort all 3 of your section subtotals. Take capitalized interest under ASC 83520, for example. That actually has to follow the qualifying asset right into investing, not operating. Or think about a finance lease payment. You've got to split that up. The principal is financing, but the interest is operating. Oh, and if you have a gain on an asset disposal, since the full proceeds correctly sit in investing, you absolutely must remove that gain from operating so you don't double count it. What about exchange rate effects? Those need their own totally separate reconciling line. Never ever bury them in operating activities. And finally, debt issuance cost amortization is just a non-cash add-back. It's not a new cash outflow. If you miss literally any of these, you're setting yourself up for a massive headache down the line.
So here's the absolute bottom line. For the areas where you actually do have a choice, like certain interest classification elections, you have to get it down in writing. You need to document those elections in your accounting policy and apply them consistently every single period. Because if you don't document and stick to your guns, your prior periods immediately lose all comparability, and I guarantee your auditors are going to flag it.
Moving right along to Section 2, restricted and non-cash errors, and the most common reporting pitfalls we see.
Let's look at how these traps play out with restricted cash and non-cash disclosures, because this is an area where auditors practically make a living finding major deficiencies. A super common pitfall here is treating a cash transfer to a restricted bank account as an investing outflow. The trap is purely psychological, right? You think, well, the cash is locked up now, so it technically left the building. But the truth? Those transfers are strictly internal. They do not belong in any section of your cash flow statement. Treating them like actual cash flows artificially inflates the body of your statement with movements that are, essentially, just purely administrative.
You really have to be incredibly careful with these related reporting errors. For instance, if you exclude restricted cash from your opening and closing balances, you are in direct violation of ASU 2016-18, and your statement is literally never going to reconcile with the balance sheet. Another huge blind spot is missing new lease commencements. Remember, every single new lease creates a non-cash right-of-use asset and liability. And please, whatever you do, never put depreciation and amortization in the non-cash supplemental schedule. D&A belongs strictly in the indirect method reconciliation. Trying to bury it in the non-cash schedule is basically waving a giant red flag at your auditor.
All right, Section 3. We know how to dodge the traps now, so let's shift gears completely and talk about thinking like an auditor. It's time for the period end test. This right here is your ultimate defense checklist. It breaks down exactly what your auditors expect you to have ready the second they walk through the door. For classifications, they're going to want a workpaper that explicitly references the specific ASC 230 sections. For any gain or loss removal, they fully expect a clean income statement tie-out to confirm that the full proceeds are sitting safely in investing. Got finance leases? You better have those amortization schedules printed out to show the exact mathematical split between principal and interest. And for non-cash completeness, just make sure your lease register is fully updated and good to go.
When it comes to areas like interest and taxes paid, you can't just hand an auditor a final number on a piece of paper. That doesn't fly. They expect to see a true mathematical roll forward. You need to step logically from the beginning balance add the accrual, and then subtract the payments to prove that the exact amount ties perfectly to your supplemental disclosure. Doing it this way completely removes all the guesswork.
And that brings us to the most important number in this entire explainer, 0. When an auditor runs what we call the beginning to ending proof, meaning they take your 3 section subtotals, add the FX effect, and then add your beginning balance, there is absolutely zero tolerance for a discrepancy. It has to match your ending balance to the penny. If you are off by even a single dollar, the audit stops right there until you find it.
So, how do we make sure that never happens? That brings us to Section 4, the period end playbook. Let's talk about your roles and controls. To actually survive these rigid audit expectations, you need a foolproof playbook. And success really starts with defining crystal clear boundaries across your team. Your team member does the heavy lifting, classifying flows, and immediately flagging any borderline items. Then the team lead steps in to independently review anything above the materiality threshold and escalate the really complex stuff. Finally, the manager takes those escalated, judgment-based conclusions, approves them, and signs off. This kind of flow ensures routine tasks are handled super efficiently, while the tricky judgment calls always get the right level of executive eyes on them.
And to back up that team structure, you need these 5 key controls. Think of them as your absolute shields against errors. First, a formal cash flow classification review. Second, a full restricted cash reconciliation covering unrestricted, current, and non-current. Third, a non-cash disclosure completeness check using your balance sheet and lease registers. Fourth, that beginning to ending proof with exactly 0 discrepancy. And fifth, your interest and taxes paid verification. If you run these 5 things every single period, you are locking everything down airtight before you issue those statements.
All right, I'm going to leave you with this absolute, non-negotiable rule from the source material to chew on. Cash flow controls must run at every period close, not just year-end. So I really want you to ask yourself, if you're only running these mandatory reconciliations and proofs once a year at year-end, are you truly audit-proof, or have you just been getting lucky? Thanks so much for joining me on this deep dive through ASC 230. Now go lock down those statements.